In today's video, we're going to run through the 3 signs that you are timing Social Security completely wrong. I'm a certified financial planner, and I've been doing this for over a decade and have had thousands of hours of consultations and helping people to understand the timing of their Social Security. Claiming Social Security is one of the biggest challenges retirees face, and yet many of us rely on generalized information, which leads us down a path where we oftentimes mistime our best choice for Social Security. Well, today I'm not only going to cover the 3 signs of a poor Social Security strategy, but I'll also show you how to mitigate them in your own life so you can maximize your own Social Security. So let's get into the video. Sign 1 is you're ignoring your financial story. The first sign that we're going to get our Social Security completely wrong is if we ignore our own personal story, our financial narrative. That is all the components that go into our financial picture. You don't want to look at Social Security in a vacuum. So your story has other parts that impacts your Social Security decision. You have other cash flows like part-time work or pensions, or the future of required minimum distributions, or maybe you have other assets that you can live from that would allow you to delay your Social Security. You see, actions in one area can oftentimes affect the other area. This is why your unique story is important. Top that off with the fact that your benefit changes depending upon the age in which you claim. You're probably familiar with this. If you claim at 62, you're going to have a 30% reduction in your benefit. If you claim at 67, you'll get 100% of your full retirement amount. And then if you wait until you're 70, you'll have 124% of your benefit. And all of this is because of your unique and personal components to your financial story. And this is why it's difficult to give blanket, generalized advice. But hang in there, I'll give you some generalized ideas in a minute. You see, it's a massive mistake to ignore your big picture story because Social Security is income. And income affects your tax bracket. And for some people, this isn't a big deal, but for others, this can equate to thousands of extra dollars in taxes. Let me explain why. So let's just call this concept cumulative benefits versus cash flows. Let's just say that Susan's benefit is $2,500 at full retirement age. If she claims at 62 and lives to 90, then she'll have claimed $588,000 from the system. However, if she waits until her full retirement age, in this case 67, she would collect $690,000 during her lifetime. That's a $102,000 difference. But she's doing exactly what I'm pointing out here, thinking about the cumulative lump sum benefit rather than the cash flows in her big picture story. Because what if I told you that Susan had $2 million sitting in a 401k, and she would be interested in knowing how the income from that 401k is going to affect her tax bill combined with Social Security. Having an explosive tax bill during her retirement isn't going to be welcomed if she knew that she could have done something to reduce that, especially because required minimum distributions are going to happen someday, and at $2 million, that's going to be at least $90,000 a year in income added to her Social Security. So here's some food for thought. If she waits to take her Social Security, she might spend some of that 401k at a lower tax bracket. However, if she takes her Social Security earlier, every dollar of Social Security that's added into her financial situation is going to take away dollars that she could have used for tax planning. If she waits to 62, then those dollars from Social Security are going to take the space that she could have used to spend some of that 401k money at a lower tax rate. So what do you think is more important? Getting the most money cumulatively from Social Security, or matching her cash flows with the timing of her benefits and her tax bracket? How can somebody coordinate their personal financial story with their benefits so they get the most from Social Security over their lifetime? First, you want to make sure you're looking at your personal financial story, and then you want to pay attention to the order of withdrawals, because order of withdrawals can impact how much you pay in taxes. Order of withdrawals simply means which accounts or account types am I taking money out of first. We're talking about non-qualified taxable accounts, traditional IRAs, and then the tax-exempt Roth IRAs. And keep in mind that money that you pull out of these accounts get added to your Social Security, and then combined, they dictate your tax rate. And this might not sound fair, but not everybody pays the same amount of cumulative taxes depending upon the order in which they choose to take their money out of their accounts. And this is a view of a person analyzing their own personal plan based on how they're going to withdraw from different accounts. And you can see that there's a different amount of total taxes due. Now, I told you I was going to give you some generalized advice, and generalized advice is always dangerous because it never applies to 100% of people. but here it goes. When it comes to order of withdrawals, most people do it this way. They take it from their taxable accounts first, their IRA account second, their tax defer account second, and then their Roths third. This means they're completely emptying out their taxable money first, then they're completely emptying out their IRA money, traditional IRA and 401k money, and then they're completely emptying out their Roth IRA third. Now, this generalized advice leaves two problems, and problem number one is that it's not always going to be best for you, so you really need to look into detail to discover which version of distributions is going to be better for you, pro rata, sequential, a combination with that with maybe some Roth conversions. The second challenge is you still need to decide whether you're going to live out of your investment money for a few years while you defer your Social Security and if that's good for you or not. Now, I'm going to change the names in this example, but 3 years ago, Tom retired, and instead of claiming his private pension and turning on Social Security, what he did instead was he rolled his pension into an IRA and did not take income from that yet. And then he did not turn on his Social Security benefit. And instead, he was able to live for the last 3 years from long-term capital gains in another account that he had at a very low to almost zero tax bracket. And the reason this is possible is because in the current US tax code, if you're in a certain tax bracket, right now it's 12% or below, you're allowed to take a certain amount of money out and not be subject to long-term capital gains. So Tom and his wife had the double benefit of living in a lower tax bracket for a few years and also growing their Social Security to be bigger in future years. Sign 2 is misunderstanding how benefit calculations work. So there are a couple of misunderstandings when it comes to understanding how your Social Security calculation works. The simplest explanation is it's a combination of the amount of years that you worked and the amount of dollars that you contributed to the system. Now, there's going to be a couple of acronyms here, and the first one is your full retirement age, and then you also have your primary insurance amount. Those are very, very similar, PIA. And that's based on your earnings history, and that is used to calculate your average index monthly earnings, or AIME. And all of this plays into your work history, so you want to pay attention to your work history. Now, it's important for us to cover this because if not, you could misinterpret what your benefit is going to be or supposed to be, and you could have one of these three things happen to you. First, you could underestimate the benefit you're going to actually receive, and then you get stuck with a lower benefit, and that could cause you to have to restrict your spending throughout your life. Second, you might miss the opportunity to boost up your benefit by contributing a little bit more to the system so that it can help you. Or third, you might be underestimating what you're really going to get, and then it causes you to delay claiming, and then God forbid you die early, and then ultimately you would have actually received less benefit from the system than you would have otherwise. So here are the key factors influencing your Social Security benefit. Are you missing years of work? What is your salary? And are you reading the fine print? Let's go over each of these in detail. Are you missing years of work? See, Social Security uses 35 of your working years. So if you discover that you have less than 35 years, you might add an extra year or two of contributions to the system to prop your benefit up. What's your salary level? You pay into the Social Security system based on your salary, and your salary affects the AIME calculation. By the way, the maximum contribution you can make for 2024 is $168,600. So if you contribute more than that, if you make more than that, you're not actually contributing to the benefit for Social Security. And what this means is that there's an upper limit to how much you can receive in benefit back from Social Security. And then third, are you reading the fine print? So if you look closely at your Social Security statement, it says that your benefit is an estimation based on what you earned last year. So that means that if you don't make exactly what you made last year, then your benefit that it's estimating is going to be different. So if you're making less money moving forward, let's say for the next 3 or 4 years, then your benefit's going to be smaller. And if you're making more money, well, then your benefit's going to be bigger. This is important because people oftentimes will reduce work right before they retire for a few years, and maybe they've calculated they're going to have a certain benefit in Social Security, but in reality, that's not true. So if you're 60 years old right now, and for the next 3 years, you don't plan on working, and you think your benefit's going to be $3,000, well, in reality, it's only true if your salary stays the same and you keep working. All right, so here's the easy way to calculate your Social Security benefits, and it may give you some insight into how you could increase your entitled benefit. So it's going to involve your earnings record, indexing for inflation, calculating your AIME, applying a formula, and then adjusting for age. But this is boring stuff for a video, right? So let me give you this simple interpretation. So when it comes to your earnings record, what this says to you is you should check your work history, make sure it looks correct to you. In 2015, I had a nurse who retired. She worked for 2 different hospitals, and she said that one hospital wasn't reporting properly. She got that corrected, and it caused her PIA to go up. PIA, remember again, is primary insurance amount. Also, you want to look at your statement, and it will say you are qualified to receive a Social Security benefit. And if it does not say that, it will give you instructions as to what to do. A couple of years ago, Nancy noticed that hers said that she was not qualified for a Social Security benefit, but then it told her she needed 2 additional quarters. So she had a small business and she was able to control how much she paid herself. So she was able to actually make sure she got those 2 extra quarters, and then it switched over and said that she is qualified for Social Security. By the way, you need 40 quarters to qualify, and that's the same as 10 years. All right, so that's the earnings record. The next thing they do is they index it for inflation. So indexing for inflation, all that means is that if you were making $20,000 in 1984, they index that up to what it would be worth today so that you don't miss out on the cost of living adjustments that have happened over the years. After that, they calculate the average index monthly earnings. So that means they take the highest 35 years, they divide that into 35 years of months, which is 420 months, and then they use that number to go to their next step, which is to apply the benefit. Now, if I tell you how the benefit works, you're gonna click off this video because it's pretty boring, but the simple version is that they give you 3 bend points, and you can always do that in a spreadsheet if you want to, but the easy thing is to just know this is how it works, pay attention to my work history and make sure that it looks like it's accurate and I'm not missing any years. The last thing they do is they adjust it for age, and as we talked about earlier, if you claim it early, you get less, so you get a penalty. If you claim it exactly on full retirement age, you get 100% of your benefit, and then if you wait longer, you have an incentive and they give you more money, so they make an adjustment for that. So as an example, if your age 67 benefit was $2,500, well then if you took it at 62, you get $1,750. And if you waited to 70, you get $3,100. So I tried to fill in the important gaps so that you don't miss out and misinterpret calculating your benefit. The important thing here is to check those years of work history to make sure they look accurate for you, and understand if you need to work a little bit longer to qualify. Sign 3 is misinterpreting spousal and survivor benefits. Spousal and survivor benefits are 2 different things. Spousal benefits are based on your spouse's work history while they are alive, and it's up to 50%. Survivor's benefits are based on your spouse's work history when they're not alive, and that is up to 100%. Surviving spouses usually suffer a reduction when they switch from their spousal benefit to only their survivor's benefit. So here's what happens. When your spouse passes away, if their benefit was greater than your benefit, you keep the survivor benefit. That's your new benefit. So before you had 100%, you had 50% of their spousal benefit or up to, and then you also had them living, so you had 100% of their amount. So you had 2 amounts coming in. So it's like you had 100% plus the 50%. When they pass away, you lose the 50%, so there's a drop in income. So here's how that could work. 2 different couples with the same benefit amount. Okay, he's 62, she's 60, his benefit is $2,900, her personal benefit is $1,500. Couple A claims at 62 and 70. Couple B claims both at age 62. 2 different couples, one is informed about spousal benefits and survivor benefits, the other one is not thinking about it so much. When couple A turns 80, they're receiving $83,000 a year, including inflation adjustments, and then that reduces down to $69,000. Now when couple B turns 80, they're receiving $68,000 a year, and that reduces down to $53,000 as a survivor benefit. So in these 2 scenarios, you can see the impact of having a larger spousal benefit and survivor benefit. One of the key things that these numbers show us is the advantage that you can create for yourself by doing something very, very important, and that is maximizing the larger benefit of the 2. And why is that important? Because the larger benefit sticks around for life and the smaller benefit falls off. So couple A probably made a better choice. Now I used extreme examples in this case so you could see the drastic difference where we ended up doing 62 and 70, and the other couple were both taking it at 62. But this applies whether they did 62 and 67 or 63 and 68. The idea here is maximize the bigger benefit. Following this video, you know what the 3 signs are that will lead to your Social Security benefit being less than you think. You can now analyze your own situation to understand if these things exist, and you can take steps to fix them. However, if you truly want to ensure you're going to live a long, stress-free retirement, there are other details and things that I was not able to cover in such a short video. So if you're interested in having a team of experts look at your situation and design a plan for you so that you can live a long, stress-free retirement, click the link in the description for a free consultation with my team. See you in the next video.